What's going on, everybody? Good to see you. Good to be back again. I just want to give you another update on what I've got going on here. I've been working on developing some algorithms for trading in the crypto markets right now. And over the past probably couple months at this point, I've been working on porting a lot of the things I had developed over to a common API that I had built a number of years ago, which was mostly built around trading the interactive brokers API and a few other stock APIs. But now porting those over to the crypto market where I can take the logic I had developed for trading or my market making algo for the crypto market here, specifically for Paradex, and I can kind of extend this to trade other exchanges without having to modify the strategy itself a whole lot to account for the differences in Paradex's API versus Hyperliquids versus DYDXs or whatever exchange I want to plug this thing into. So as you may know, I've been working on an algo for market making, just pure market making, but I'm also looking at funding rate arbitrage. So basically the difference between, or collecting the difference between the funding rates on these perpetual futures contracts between two different exchanges, but while being delta neutral. So basically being long on the exchange where the funding rate is the lowest, and then being short on the exchange where the funding rate is the highest, and then collecting the difference between those two funding rates. Now, I have noticed that it's not as easy as it seems, because sometimes these funding rates, the spreads between these funding rates just blow out, get crazy high, right? They look super juicy. And it's very, very tempting to just go ahead and jump in and go ahead and pay the spread, pay the commissions, and then just collect the premium at that point. But are you actually making money in the long run after you take into account the bid-ask spread between the two exchanges, and then also the commissions that you're having to pay, whether or not you're paying maker fees or taker fees? Those are usually charged at different rates. And so what I wanted to create is like just a dashboard that would give me some insight into like what I'm actually paying here and what I'm actually collecting, right? And this is from the perspective of the spread. So I already learned the hard way. You don't want to use limit orders for both sides of the trade, because if you get in on a limit order on one and trying to save a few basis points on commission, get in a limit order on one side, on the long side, say, and then you try to get in on the other side, on the short side, with a limit order as well, and then the market just takes off, and then you can't, and then there goes all the savings you had from using limit orders. So it's best to get in on a limit order if possible on one side of the trade, and then as soon as that order is filled, go ahead and just cross the spread and get in on a market order on the other, and preferably using a limit order on the exchange with the lower liquidity. So anyway, but for the time being, actually Paradex is offering 0 commissions on both maker and taker orders for most pairs except for Bitcoin and Ethereum, but everything else is free trading for UI traders. Now, if you're an API trader, automated trader, you're getting free maker fees, not paying any maker fees, but you're still paying 3 basis points taker fees on API orders. So not a total free lunch here. But anyway, I digress. What I wanted to see, though, is basically, okay, what's the spread on these? Because sometimes you might be actually getting paid to go ahead and get into this trade. So what we're taking a look at here is so first we got the pair, which in this case is Hype. We have Paradex and Hyperliquid exchanges, the bid and ask at each exchange, what the spread is in terms of basis points. So we can see here Paradex is a little bit wider spread. It's fluctuating between like 2 and 4 basis points. Hyperliquid is quoting pretty tight at 0.2 basis points. And then we can see the funding rate difference. So we can see that Paradex is paying a little over 20% annualized and Hyperliquid is paying 10% annualized. So I mean, there's a 10% gap here between the two exchanges and what they're paying. So I mean, we could in theory collect 10% times whatever amount of leverage we want to use on this. And so the next box here is basically showing, okay, what is the difference in the spread? So if we're going to buy at Paradex and sell at Hyperliquid, what are we paying if we cross the spread for both of those trades? And in this case, this is actually costing us, anywhere from negative, or costing us anywhere from 4 to 10 basis points by crossing the spread, because the prices are worse. Now we want to actually go short. If we were doing a funding rate arbitrage, we actually want to short Paradex because it's got the higher funding rate, and Hyperliquid's got the lower funding rate. So if we're going long Hyperliquid and short Paradex, the spread is actually in our favor on this, meaning that if at some point, those funding rates are probably going to converge, in which case the spread is going to converge as well. So we might make 5 basis points on the spread, in addition to collecting about 1/10 of a basis point per hour while the trade is open and while these funding rates stay where they are. That's the other key to this, is the funding rates aren't always super stable, especially for some of these lower liquidity coins. So yeah, basically, I don't want to get into a trade where, the spread between the coins is like at negative 20 bips, because I'm paying 20 to just even take that trade. And, how long is it going to take me to make that money back just from collecting the funding rate every hour? So I've got a few other coins here that I'm monitoring as well. We got Solana. The funding rates not the funding rates are closer, actually. There's only a 3% difference. The spreads are more comparable, though. We're seeing Hyperliquid has slightly better prices to buy, but the way that they're bouncing back and forth, not as bad as Hype is. Let's see. Now we got Fartcoin here, and the reason I included this, the funding rate spread was a lot different earlier. I think it was up to about 50% difference between the two. Now it's sitting at about 25% difference. So still quite a bit there. Now the interesting thing is the lower spreads on the lower funding rates on Hyperliquid, meaning we'd want to go long there and short on Paradex, and we'd collect about 1/4 of a basis point per hour. But if you look at how much it's going to cost you to enter this trade, you're going to lose 30 to 40 basis points right off the bat by doing this. Now this is assuming, again, you're entering using market orders. Now if you can get in with a limit order and update your limit orders, this is the tricky part. If you're trying to get in with a limit order, you want to update your limit order so you don't get picked off by some informed trader that's just going to turn around and then hedge themselves on Hyperliquid, and you just gave them free 20 basis points. But so yeah, this would be entering with market orders. So you can see the reason the spread is so bad is because the spread on Paradex is 33 basis points. So I mean, this kind of highlights that trading a market making algo on Paradex could potentially be profitable, and then offsetting the trades maybe on Hyperliquid where the spreads are tighter. You could potentially be trying to actually capture this spread, and at the same time, while your positions are active, if you're hedged on the other exchange, you can just enjoy this 26 or 0.26 basis points per hour while you sit in that trade. So I've got a few other coins here pulled up. Now this one was crazy too, Linea. The funding rates were way different earlier today. Now they've converged a bit and they're pretty close to each other. So 145% annualized. But the difference between the two exchanges is rather small, so it's almost even actually. But again, we see Paradex has lower liquidity. And the thing too about Paradex now is they've kind of changed up their how their order book works. And so since they have now kind of two segments in their order book, they have an API only and they have a retail only quotes in there. Meaning if you're trading an API app, you can't see quotes from your app that are meant only for retail traders. You can only see those quotes in the UI on their website. And this is meant to give the retail traders a bit more price improvement potential on their trades. And then at the same time, you can post retail only orders from an API app, but it's going to cost you 3 basis points in order to do that. So if you're worried about people picking you off or other bots picking you off, you can post just retail only orders into via the API, but it's going to cost extra in order to do that. So the spread, if you were to look at the actual Paradex UI, it might be it's quite possibly tighter than 22 basis points, but the spread is 22 basis points if you're trading against other API apps. So let's take a look and see what else we got here. We got XRP. Spreads are quite a bit tighter there. So almost zero at Hyperliquid, about 2.5 basis points. And so we see the net spread is pretty even there. Funding rates are even as well. And then we got Ethereum here. Again, pretty tight spreads on both exchanges, as well as the funding rates on both exchanges are pretty even. So we're not seeing really anything interesting here. And then finally, Bitcoin spreads are super tight. Now it's interesting, the funding rate on Paradex is a bit lower, but not enough to really be enticing. Although obviously with Bitcoin you have got higher leverage, so you could magnify this spread difference a bit more. So if the spreads move more in your favor on one exchange versus another, you might be able to go ahead and get into a trade here without too much cost, and collect maybe 1/4 of a basis point per hour, or even a half, while these spread differentials are in place. So anyway, I'm going to continue to explore what I might be able to do here as far as from both a funding rate arbitrage angle, as well as a market making angle, and possibly kind of incorporating those two things together, where I am basically doing market making on one exchange, but I'm keeping an eye on the other exchange, looking at the spreads, looking at the funding rates, and using that to adjust my market maker quotes. So I'll leave it at this for now in this video. I've got another new UI set up for my market making algo, kind of a dashboard for it. I have just pretty much dumbed down my market making algo from where it was previously, and I'm kind of rebuilding it from scratch within this new kind of common API framework. And I'm slowly adding pieces back in, various pieces of functionality that were in the original one. So right now it's super dumb algo. All it's doing is posting quotes at a fixed spread, refreshing those quotes periodically, and then they'll get hit, and I'll have a certain amount of inventory available on both the long and the short side. So once all that inventory maxes out, then I won't post quotes on that side. But that's pretty much all it's doing. So just even given those dumb rules, I'm kind of curious to see just how it does before I start adding stuff back in. So I'll keep an eye on that as well, and I'll show that UI dashboard in a separate video. So anyway, hope you guys are having an awesome week, and would love to hear about what you're working on, and any problems that you're having, what languages that you're using for development and testing and all that good stuff. So I hope you guys are having an awesome week, and I will talk to you later.